All right, today's going to be a fun, laid back, and chilled video. We're going to be looking at two brand new ETFs that go head to head against the very popular NUSI, which is a risk managed income ETF. Quick little background, NUSI is one of these ETFs that has an option based strategy, much like QYLD and even JEPI and DIVO. And the reason why these are gaining so much popularity right now is because they're really good at generating income when we live in a low yield environment. So the 10-year treasury is kind of a bellwether, and right now it has a yield of 1.579%. And looking at this yield historically, it's usually way more. Right now we're at an all-time low, so it leaves people that want income looking for higher yielding alternatives. And of course, that's where funds like NUSI and these two new options I'm going to talk about come into play. So the new funds we're going to be comparing against NUSI are from Global X, the maker of QYLD, which I believe is their most popular single ETF. But anyway, the new ones are Xrmi. This is an S&P 500 risk managed income ETF. They also have QRMI, which is the exact same, but based off of the QQQ. And that one in particular is going to be the closest comparable to NUSI. We can see how this fund came into existence in late August of 2021. So we're not going to do any historical price performance comparisons or anything like that. Instead, we're going to look at the methodology of these funds and see how they operate and how they're different. And the second fund I want to talk about, it's a little bit different, but it uses a very similar strategy. And this is Xclr or QCLR if you want the NASDAQ equivalent. Now, the first thing I have to note about this ETF is that it is not an income-focused ETF. It's focusing more on growth using a very similar strategy as XRIM and by extension, NUSI. And I think it's going to be a valuable thing to touch on, give you a bit more perspective and how this protective collar can be used to achieve different outcomes. So we're going to take a deep dive into these funds in a second, but I really quickly want to show you a visual of how the options in these funds work. So NUSI, XRMI, and XCLR all have a call option and a put option that they use on top of an index. With NUSI, the index is the QQQ, and with these Global X funds, you could choose the S&P 500 or the QQQ. The main difference between all these funds are the time frame and where these call and put options are located relative to the price of the underlying index. And by simply manipulating these few variables, you can completely change the characteristics of these funds. So let's begin with XCLR, and as I mentioned, this is not an income-focused ETF, but it's using a very comparable strategy to achieve growth in this case. So XCLR enables investors to participate in the growth of the S&P 500 up to approximately 10% from the selling of call options expiring in 3 months. By employing a protective collar strategy, XCLR aims to lessen drawdowns to approximately 5% from the purchase of put options expiring in 3 months. So it's pretty simple. In summary, this version is based off of the S&P 500 index, and they have a call option 10% out of the money and a put option 5% out of the money. And the thing that I love about the ETFs from this company, Global X, is how systematic and transparent the whole ETF is. So these are the holdings, it's just the S&P 500, and right here are the options. This is the call option and this is the put option. Very simple. And right now the price of the S&P 500 is 435. The strike of the call option is 489 and the strike of the put option is 422. So this is your maximum loss and this is your maximum gain. And being that these options run for 3 months and then it's just rinse and repeat, they expire the 17th of December, so they have 71 days left. And putting this visually on a graph, this is what XCLR looks like. We have the price movements of the S&P 500, the call option is 10% out of the money, and the put option is 5% out of the money, and this is all on a 3-month time frame. All right, now let's compare that to XRIM. This is the risk managed income ETF. So this one is the direct competitor to NUSI. So the main difference here is that this one is focusing on income instead of growth. So XRMI seeks to generate an alternative source of income by selling covered calls. XRIM buys protective puts to mitigate the risk of major market sell-offs. The ETF seeks to achieve this outcome by owning the stocks in the S&P 500 while buying 5% out of the money put options and selling at at-the-money call options on the same index. And this is what that looks like. We have the index right here and the call and put options. So again, putting this visually on a graph, this is how Xrmi looks. The first thing to note is that the time frame is different, so these are on a monthly basis, and they do that in order to have monthly payouts. Just like with Xclr, the put option is still 5% out of the money, but the main difference here is the strike price of the call option. So the call option is at the money, so it's very close to the actual price of the index at time of selling the contract. And they do this because at-the-money call options generate the highest premiums and therefore income. The trade-off, of course, is that it completely limits any price appreciation. And coming back to Xclr, which focuses more on growth, that's why the call option is 10% out of the money, to give you this room to have potential capital appreciation. But it has the inverse trade-off, so it generates a much lower premium, just enough to buy the put option with. Now, trying to compare this versus NUSI, NUSI is managed differently. It's not nearly as transparent and systematic as the Global X funds, which is a huge benefit to those in my opinion. I mean, as we saw, they list the exact options they have along with their strike price. And in contrast to that, Nationwide does not openly state the strike prices and expiration lengths of its options, and it seems that it may be up to managers' discretion. Although on any given month, there should be roughly a 1-to-1 relationship between the NASDAQ and NUSI, as long as the NASDAQ's gains or losses are within 10 to 15%. So trying to put that visually on the graph here with NUSI, the time frame is roughly a month, and the price movements of the QQQ are allowed to move up and down roughly 10 to 15%. So the call and put options must be somewhere in that range. To try and get more insights on NUSI, we can look at it side by side versus QYLD, which has at-the-money call options on the NASDAQ 100. And the price movements are not exactly the same, but they're very similar. So that leads me to believe that most of the time, NUSI has at-the-money call options. And if we look at the most recent crash in March of 2020, the price of NUSI went down about 10%. So that must be where the put option was. So after looking at the functionality of these ETFs, I have to say I admire the approach and functionality of the ETFs from Global X. They are super transparent in how they operate, and they're completely systematic, so you know exactly what to expect now and into the future. And on top of that, they have a wide variety of options to choose from. So Xrmi is the risk-managed S&P 500 ETF, and up here we have QRMI, which is off of the NASDAQ 100 index. The same thing applies with Xclr and QCLR. They even offer a more simple ETF, which is just a QQQ with a put option on it, or the S&P 500. So there's something to be admired about the approach this company is taking, enabling you to get the exact product you want. Okay, now in terms of the dividend of Xrmi, to see how it compares versus NUSI, this ETF is brand new, and they have exactly one data point when it comes to the dividends. So far they paid one dividend of roughly 20 cents. Now, just for fun, we can try to extrapolate this out over the course of 1 year, although this is completely wrong. There's not enough data to be able to do this, but just for fun, 20 cents times 12, because this is a monthly payout, leaves us an annual income of $2.40 per share. The share price right now is roughly $26, so divide by 26 leaves us a yield of 9%. Now that yield is going to be completely wrong, but comparing it versus NUSI, which has a yield of around 7.5%, I would say the yields between them should be pretty comparable. And if that's the case, personally, I would go with Global X just because of the added transparency, as well as being able to choose which index you want this to be based off of. Okay, so when it comes to my portfolio and what I'm doing, I like investing for dividends and income. I'm not exclusively a dividend investor. I split my assets between growth and income. And as mentioned in the beginning, we currently live in a very low yield environment. So in order to achieve competitive rates of income, I think these option-based ETFs are a good option in this market. With that said, I would never go all in on these funds. Rather, I would use them within a greater, more diversified portfolio to precisely adjust the income level that I want. In my previous video, I talked about the benefits of combining a fund like QYLD with the QQQ. And these new funds, Xrmi and NUSI, are very similar, but they offer some downside protection as well. So if that's something you're interested in, these could be an even better option. In the near future, I think I'm going to change the income side of my portfolio to look a lot more like this. I'll have my favorite income ETFs like JEPI and Divo, as well as some exposure to the systematic covered call options. I like how they remove the human element, and you can use them as a tool within a greater portfolio to adjust the exact dividend yield that you want. But that's just my take on it. Let me know in the comments down below what you think. If you're still watching and enjoyed, give the video a like, subscribe, all that YouTube stuff, and I'll see you in the next one.